We start off with Absa Bank. The company reported headline earnings for the first 6 months of this year, rising by 19% to 4.6 billion rand. Headline earnings per share also increased by 19% to 638.5 cents, while dividends went up by a hefty 30% to 292 cents, compared with 225 cents in the comparative period last year.
Absa market cap 95 billion, price earnings ratio 10.5 and dividend yield 4.5. Anthony, let's start with you. On the surface, numbers not bad. I mean, headline earnings up 19, dividend plus 30, looks nice, but the market's not getting excited about it. It's kind of like they're saying, well, heck yeah, it's 2011 by now. You know, we saw Nedbank yesterday as well with similar-ish sort of numbers. They're very much expected. You know, the worst is behind them. The big question is where to from here? Where's the rest of the growth coming from, I suspect?
Yeah, I think the retail bank did well. The rest of the units were kind of flat. Yeah. The retail bank did better on kind of muted top line growth, better credit impairments, some cost containment. So really that's coming off a low base as well. But I think really this thing is still trading on a forward P of 9. Dividend yield is quite good, 4%. But the prospect statement talked about them being quite exposed to a very vulnerable South African consumer. And with the prospect of interest rates going up, the outlook statement was kind of guiding towards a very muted outlook in the next 12 months.
Okay, so Anthony, I mean, at the end of the day, when you're alluding to the market's not really approving of the numbers in a sense, we saw Absa up 0.8%, very different to the overall market. The market was down 1.25%. We saw Nedbank coming under pressure today, so a nice little rise coming through in its share price. Do you think it's on the back of investors feeling more optimistic when it comes to that dividend increase?
Yeah, I think so. I think also really it could be also ascribed to the fact that there's some quite good growth opportunities in Africa on the back of the Barclays franchise. I think that the bank is ostensibly well run. I think that there is big room for them to cut out costs. And you know, really it is a great franchise in terms of an eventual pickup in consumer spending.
You mentioned a bunch of things I want to come to there, but let's first go to Yonatan on the wall with the chart. Yonatan, if nothing else, what we're seeing here is a stock that's broadly gone sideways now for approaching 2 years.
Well, yeah, I mean, Absa for the last couple of years have been trading between the range of 141 Rand on the top side, 123 Rand on the bottom side. But what's more very interesting in this chart, Simon, is the two pictures in one over here. The first picture is the overall long-term trend, which is the 2-year sideways trend that we spoke about. But accompanying that is the on-balance volume, which we mentioned previously on this program. It's the smart money leaving the stock of Absa. We can see the lower highs, together with the lower lows in the on-balance volume. So the smart money overall is looking to leave Absa, and very much pronounced in the short term, in the 2011 little rectangle that Absa has been trading between 138.50 and 133 on the bottom support. Absa has pretty much bounced off the bottom support of 133 for the 6th time now. So yeah, we could see a higher share price to around the 138.50, but I don't see huge prospects for Absa in the long term.
Okay, with regards to the moving average there, is it a 200-day moving average that we're seeing? With regards to the significance, the fact that it has been bouncing quite significantly for over a year within that range, is this a significant move? Or
well, yeah, I mean, it is a significant move. The fact is that the 200-day moving average is flattening out. Prices have been struggling to maintain above that moving average. So we are finding a little bit of resistance around the 134 level. I think that's pretty much where we were today. And it really depends on how this market reacts from here on in. I do see the resistance, and I do see Absa struggling to maintain these kind of levels for the time being.
Bringing back to you here on the desk here, I mean, what we've got is you mentioned costs up 8%, staffing costs up 13%, which I think we're going to see the flip from Standard Bank because they did that huge retrenchment towards the end of last year. But their cost-to-income ratio is 54.8 versus 53. Banks really want that number 50 or even maybe 48%. Costs are still the issue, broadly struggling with that. I mean, some good numbers out, but lots of costs.
Yeah, lots of costs, lots of IT spend to come as well. They have highlighted the fact that they want to spend a large amount of money on IT to get the efficiencies, to get the productivity through. So it's going to be difficult to get that cost-to-income ratio down in light of kind of a tight skills market in terms of staffing and big capex spend in terms of IT to come.
With regards to net interest margins, we know that one thing that has put Absa in good stead is the fact that they've hedged themselves, and we know that that rolls over on a 3-month basis, and it should in fact expire, I think, June 2012. Again, it's got to do with the interest rate cycle. What do you think the next move should be? I spoke to Maria Ramos a little earlier, and she was saying that, you know, they don't speculate, but of course they do price in certain scenarios, and they do expect interest rates to remain unchanged until next year.
Yeah, I think in their prospect statement they said that they expected interest rates to start rising in the first quarter of next year. And yeah, I think that the credit cycle will be kind of muted. Again, the consumer is under a lot of stress. The personal debt to income ratio is still up around 80%, which is historically near its high. A million jobs have been lost in the last 2.5 years. There doesn't look like a real resumption in being able to extend credit to on discretionary items like cars and houses.
Yeah.
So until that happens, you know, I think, you know, again, prospects are muted for the banking sector.
Yeah, I mean, loans declined 1%. You mentioned impairments earlier. Overall impairments down at 1.46. This is for the retail space versus 1.9. A sharp movement better, but I suspect they get into the hard part now. They've kind of got those easy gains in. Getting it from 1.46 down to below 1% is going to be tricky. And I would imagine a fair chunk of their profit came from that significantly improved impairment.
Indeed. I think, again, in the retail bank, you know, reduced impairments, cost containment, muted revenue growth equaled 175% increase in headline earnings per share.
Okay, Yonatan, looking at the smart money, you were talking about we're starting to see that trend changing quite significantly over the past while. We've seen these kind of movements before.
Yes,
right?
No, absolutely. We've seen these kind of movements, and this is a leading indicator. So on balance volume is leading the market. So it's basically telling you which direction the market is going to be taking. Now, again, going back to the chart, I mean, we've often said that this is a trader's market for the last couple of years, meaning that it's pretty much range bound, and it's great for traders because you can buy it at the bottom of support, looking to sell it at the top resistance level, and again, very much in the smaller band between the 133 and 138 level. The significance of the on-balance volume, the accentuated acceleration of a downward movement is very significant in the market.
Yeah. Simon, you've got another tech question, I'm sure.
Yeah, I'm interested in that significant acceleration on non-balance volume. And does that suggest that if we're going to get a break, and we had to preempt, that it's more likely to be the downside to your 128 or even back to your 123 level?
Yes, absolutely. I think the first support after the 133 level is this rising orange line over here, which brings it up to about 128 Rand, which is the support level. Which we should find a bit of support over there. Prices should react to that support level, but ultimately, Simon, I think that we are going to look for that 123 level.
So, Yonatan, hot or not?
Not so hot.
Not so hot. Anthony?
Also not so hot.
Not so hot. Were you paying a lot of attention there to some of the technical aspects?
Not really.
Not really. I must say, it was quite evident. Tell us why, Anthony. Why are you not interested in
we
the
focus
technical?
on fundamental analysis.
Yeah.
Obviously,
not even
there's a
paying
timing
a bit
element.
of interest into the smart money and the fact that it is leaving
See, he
Absa.
is the smart money. That's why we
left a long time ago, based on a fundamental call.
Okay, so not hot for you then?
Not hot. Yeah.
Okay.
Not hot. I mean, great dividend yield, 4.5. But I got enough banks in my portfolio, and I worry where's it going to come from.
And Capitec is the one bank,
and Standard's the other.
And Standard.
And no, I paid for my Standard shares. I worry where they're going to get their profits from in a year's time.
Okay, let's delve into the next stock. Capital Shopping Centres reported a 14% rise in underlying earnings per share to 8 pence for the 6 months ended June 2011 from 7 pence last year. The company, which is the UK's biggest mall owner, reported that the number of people visiting its shopping centres increased by 3% during the period. Underlying earnings were up 53% to £66 million, while net rental income from continuing operations was 32% higher at £178 million.
Market cap of 35 billion rands, negative price earnings because they are not yet making money for a full year, and a dividend yield of 3.5, and that's obviously taking exchange rates into assumptions. Anthony, the thing what gets me here is they got some brilliant assets. They got some great shopping centres, and they're doing fairly well. 97% occupancy, 6% growth in like-for-like rental income. What strikes me, significant debt still sitting on their balance sheet, and I'm desperately trying to find the number in my sheet. But it was running at a couple of billion. I suppose property guys are always going to have large levels of debt. They've gone and bought the asset, and now essentially they're paying it off.
Yeah, well, debt to equity is 48%, which
I
I argue is quite low for a property stock. But yeah, they own 14 shopping centres in the UK, 10 of which are in the top 25 centres, which is a quality portfolio. But again, I think it's on a forward yield of about 5.2. It's difficult to see where the NAV growth is going to come from in the short term. Rental increases are muted. And I think also, the one positive that you can mention in terms of this is that there's no new shopping centres coming online, no large new shopping centres coming online in the next 2 years. But, I think it's really a play on, UK retail environment, which seems to me at best
which
muted.
is not a great play right now, frankly.
And I mean, obviously in the intro, when we saw that the increase of people walking through the doors increased by 3%, and this is at a stage where we actually think that the UK economy is coming to a grinding halt. But we know that some of the assets that Capital Shopping Centres does have in its portfolio are in very good state. But I think you hit the nail on the head with regards to rental income, and we know that those estimates are starting to come below what they initially had hoped for.
Yeah, I think that the Trafford Centre is doing well. That's, I think, saw a 6% increase in footfall. But again, with austerity measures in the UK, the retail consumer is under pressure and will be for some time as they pay down debt.
Yonatan, let's come to you on the wall with the chart. I mean, what we're seeing here is again a range it's been trading in, but a range that is becoming narrower and narrower.
Yeah, absolutely, Simon. And again, not forgetting that this stock has fallen from grace from around 140 Rand highs in 2006 to around the 30 Rand low in 2009. This stock is formed what we call a symmetrical triangle, which is actually classified as a continuation pattern, which means that it should continue with its preceding trend, which is obviously the downward trend. A couple of interesting facts over here as far as the stock is concerned is that this medium-term trend line, this medium-term bullish trend line or the support line from 2010 to the 2011 level has been breached in the second quarter of 2011 and has been able to maintain below that level, which is quite significant, meaning that the trend could start changing direction again. We're looking at short-term support at around 40 Rand 50 cents, and again the very long-term support, which is going back to 2009 at 38 Rand 50. But I don't expect the stock to be trading very much above the 44 level or below the 38 level for
Tell me
the next
about
couple of months.
liquidity when it comes to this stock.
Well, we need liquidity, obviously. I mean, I haven't put up the volume to see the kind of liquidity over here, but the more liquidity that we have, the more valid technical analysis becomes. It's very difficult to do technical analysis on an illiquid stock because it can be manipulated by some big investors.
Okay.
Anthony, bringing it back to the numbers, so to speak, the fundamental part of it, market value of the investment's up 35%. Now, two things hit me there. One is, I mean, they paid someone to value their properties, or am I being overly skeptical? And a 35% jump in an economy which, at best, we can call, under pressure.
Yeah, I mean, I think you're right. I think it's done by directors with expert advice.
I want to be that expert.
And I think this revaluation is a function of low interest rates. So again, I think it's difficult to see from this base where future increases in NAV are going to come from. Again, if you're pricing this thing in Rand and the Rand weakens, I think all this technical analysis might be for naught because it really is a pound play.
Okay, a pound play, but again, do you agree that the assets are very good?
Quality assets, yes.
Okay.
They've got some interesting. They've got a holding in a US group who's got 177 shopping centres. I mean, it's just an astounding number. They're looking into India, where they've got a 25% in a Prozone who's only opened their first centre, so that's very, very early days. So they've got a little bit more, but it still is, if you look at their earnings, this is you say a pound play, yeah, it's also a UK economy play. And again, we come back to the point, I know we're beating around the bush with it, we're flogging it, but to the point is, it's not an economy you want to be jumping into. The West is having a rough time of it.
Yeah, I mean, I think most people in the West are looking at emerging markets to invest in. You know, I think the investment case on the stock really rests on if you have a predisposition to buying property in London or the UK, and you don't want to have the risk of a tenant.
Yeah, you don't want to have to
a lot of my friends, for example, are buying or thinking about buying flats in London.
Yeah.
Now, this is an alternative to buying a flat in London.
Yeah, buying an individual flat at Canary Wharf and hoping you get it filled. So, Anthony, capital shopping centres, hot or not?
Not.
Not hot.
Not. Nice, simple. One word. Yonatan, for you?
Not.
Not hot. Okay, Simon?
No, because you might score on the pound, but this is, you know, the UK, that's not an economy you want to be pouring money into just yet.
But when everyone doesn't, a contrarian view though.
Yeah, but
perhaps
you don't want to
when no one wants to be in.
I'm a big fan of contrarian view, but I think there's a time for contrarian, and I think that this is not the time here. This could get, the UK is a long way from looking good again.